Tonight's Interbank FX webinar is aggressive swing entry. So we're going to do this talk in a couple parts. I'm going to assume that just for the very beginning portion of our talk, that we're going to basically start from scratch in terms of what a swing trade is. So I'll take just a few moments to introduce and teach that concept, because part of an aggressive swing trade is not necessarily being able to capitalize on the more conservative or more traditional idea of what people consider a swing trade is when I'm describing it, which is utilizing the 34 EMA wave. So we'll get to all that in a moment. When it comes to aggressive, the wave becomes certainly our trend tool, trend identification tool, but it may not necessarily be our entry trigger. So that's what we want to keep in mind when it comes to the entry itself. I do want to also remind you that there is a text box there, so if you have any questions, please feel free to type them in. And in the meanwhile, let's go ahead and start defining what a swing trade is. All right, in terms of the swing trading definition, now let's head on over to our charts here. All right, so when it comes to actually defining what a swing trade is, my go-to tools, as always, typically focus on my 34 EMA wave, and then also as a measurement of sentiment and momentum, my GRAB, my green, red, and blue candles. In terms of the sentiment and the momentum, obviously, I think visually you can see the dominance of the red GRAB candles when prices are pushing to lower lows and being resisted at lower highs. So you'll see in a downtrend, for the most part, the dominant color is the red, reflecting that bearish sentiment, and therefore also cumulatively that bearish momentum. When you have enough bearish momentum and bearish sentiment, you have those steady stream of red GRAB candles, what you'll eventually see, usually, is the 34 EMA wave starting to travel lower in what we call that 4 to 6 o'clock angle. And when we have that 4 to 6 o'clock angle as measured within that market look back, that market memory, this happens to be the daily Swissy, the daily US dollar Swiss franc. So I have a look back of approximately 1 year, which is what you see in your view of just about 11 months here. So what you'll notice is the 34 EMA wave moving down lower. Now this is not a terrific 4 to 6 o'clock angle, but prices are very much in that markdown or downtrend. And typically what we would be looking to do is wait for prices to make some sort of bounce, in other words, a correction higher, and conservatively I'm usually focused in on the 34 period EMA low as an initial trigger for a swing trade. In other words, relying upon that initial level of resistance offered by the wave in the markdown market trend to trigger a short. Now, I have to reiterate, if there's anything that I truly believe that I hope I get across every time I open my mouth about the markets, it's this. Let the market psychology, let the market trend dictate your strategy. Okay? I think that to have a bias to say, oh, today I'm going to do this type of strategy, this type of tool, this type of methodology or system, without considering the message of the market, you're swimming upstream. You're fighting the dominant psychology. You're fighting the market flow. Okay? Trading is difficult enough, and when you don't necessarily listen to what the market's telling you, in my opinion, you're just making it exponentially tougher. It's always been my experience. So when I want to fight the market, when I have an agenda that does not begin with listen to what the market is telling me, I'm just preparing myself for the wheels to come off the wagon. Okay? So I'm sure a lot of you know that's the textbook swing entry. Start with that market look back, identify either the 12 to 2 or 4 to 6 o'clock angle of the wave, wait for that correction, in which case, in the case of a downtrend, it's a bounce. In the case of an uptrend, it's a pullback. Wait for that correction. Identify where the resistance is in a downtrend. Identify where the support is in an uptrend, and then set up your trade. Now, the idea of identifying where the resistance is in this downtrend in terms of the dollar Swissy is an interesting prospect, because consider that that's a pretty open-ended statement. Support, resistance. I've left kind of the definition of that fairly wide open, right? And there's a reason for that. We can have conservative and aggressive levels in terms of where I feel the selling pressure may build, prevent prices from moving any higher, and even more so, enable the overall trend on the time frame to resume. That's the key to swing trading. So one of the things I'll tell you, and one of the things you'll probably notice, let's talk about the current market right now, because I'm probably not giving you a news flash, but right now the market is in a tremendously challenging market phase and overall fundamental psychology. So let me go ahead for a moment and let me just bring up our good old note-taking tool. I'm just a fan of using Word. Makes it easy. Nothing fancy. Okay. Let's head on over to Word and talk about this for a moment. What's going on in the market right now? Because the market is really tricky right now. Okay. How many of you have noticed out there just how challenging this market's been? Quite a few reasons, right, for that? No shocker there. It's quite a few reasons. I think it's easy just to dismiss the whole thing as grease, but we know it's so much larger than that, so much bigger than that. What are other issues that we're dealing with right now? You got the Fed on hold, right? We have the ECB dealing with, kind of going back and forth with inflation. We have the BOE doing the same thing. Okay? In terms of whether or not they're going to hike. They keep putting off a potential rate hike, right? We have this safe haven run to the franc, the Swiss franc. Okay? In terms of our risk barometer currency, the yen, what's it doing? It's just moving sideways, hovering above 80, not telling us much. Okay? What else is going on? Now those are just, just some general, it's a general list. I mean, really, in terms of fundamental versus technical issues, I guess we could say these red top, let's shade this in red. Is it not cooperating for me? All right, well, I'll just make these bold. Okay, the bold part of this list here, those are probably a pretty good assessment of what's happening fundamentally. Technically, what's happening? I think, obviously the yen moving sideways, and I think another interesting aspect to the current market action is the U.S. dollar index moving sideways as well. Now, why is that such a big deal? Well, we know that the dollar index, the dollar itself, is half of the pairs that most of us are using to trade, right? In other words, the euro US dollar, the dollar yen, the Aussie US dollar, the dollar index, the dollar itself becomes a big part of what we do. If we can't assess what's happening in the US dollar, it's really difficult to assess what's going on in the pair, right? So half of our consideration, in terms of the pair is what's happening to the dollar, what's affecting the dollar, and that brings us to the Dow, and that brings us to what's happening with bonds, and what's happening with the Fed, and what's happening with crude oil, and all these other things, right? So we definitely want to keep all that in mind when it comes to what it is we're determining the dollar index is telling us about the relationship of the pair, right? So when the dollar index is sideways, when any daily time frame is moving sideways, what happens? Well, we got to bring up directional bias here, because anytime I'm talking about aggro swing trades, I'm usually talking about less than ideal circumstances under which I'm trying to trend follow. Now, I'll tell you, when you look at the daily time frames of a lot of the pairs, let's jump back on over to our charts here. And by the way, again, how many of you have been really, challenged by this market? There's some pretty good reasons as to why this market's been challenging. And again, I think those are just a short sampling of what's going on. So part of the challenge comes from, in particular pairs, not all the pairs are difficult right now. I think, it's very difficult right now, I think, to trade the dollar yen. I think the answer is fairly simple. Take a look at the daily chart. When I lack directional bias on the daily time frame, when there's no clear-cut indication of some sort of trend, what happens? We end up with a situation where there's no dominant psychology. When there's a dominant psychology on the daily, it's my opinion that in a very general sense, in a broad sense, it's easier to trade. Now, I say easy because, I don't want to make it sound like trading's easy just because there's a trend on the daily, but it's much easier to assess whether or not traders are going to start piling in at resistance levels or start to come in and support a floor. The reason for that is when there is that dominant psychology, there's a clear indication of when and why traders will do what they're doing. In other words, if there's an overall uptrend, when I say overall, we're talking about that daily time frame. When there's an overall uptrend, it's a lot easier to, in many ways, I don't want to use the word assume, but there's a higher likelihood that traders will step in and support pullbacks because people have an overall expectation of higher highs and lower highs. Higher highs and higher lows. Sorry, higher highs and higher lows. It's important to remember that while the daily chart may not be the most tradable, one of the things that you want to keep in mind about the daily chart is the fact that it is, I think, the most accurate reflection of what's going on in the pair in terms of that psychology. If you lose sight of that, then you're definitely going to lose sight overall of the biases that the overall market is keeping. Okay? I hope that made sense, because if you lack a directional bias, what's another chart that's lacking directional bias right now, and I think it's eating up a lot of traders alive? The Euro-US dollar. Think about the pairs that are kicking your butt right now, that are making your trading life difficult, and then look at the daily chart and ask yourself, is there a dominant up or down trend on the daily? Because if there's not, one of the things that you might want to consider is leaving the pair alone. Consider that maybe you want to focus in on one of two things. First, a time frame, a daily time frame that does have that directional bias, up or down. Or two, focus in on shorter term time frames where you don't need as much organization of sentiment, momentum, and trend in order to get follow through. Because I think that's what a lot of us are experiencing right now. It's not a lot of follow through. The market's kind of choppy. And chop comes from a lack of organized, market sentiment, organized momentum, and then obviously the result of those is finally a trend, right? So again, the chances for follow through, the chances for the trend to continue are much higher when we have the daily giving us a clear picture of what traders are thinking in that bigger sense. Now, when we don't have that, okay, when we don't have that, what do we have? I think we have a situation where we go to the shorter term time frames in order to get, one, some sort of clarity on the direction, because we are looking to trend follow here, right? We're talking specifically trend trading. Or what we want to do is also remember that the follow through that we're going to get, because the daily chart's lack of direction is going to be less, and therefore the shorter term time frames are a more realistic time frame to enter on in order to get follow through higher or lower. Now, in terms of, and I'm just going to address some of the comments or questions that have popped up on the text windows here. Yeah, I agree with you, Mark. It has been very challenging. Even traders that have been at this a long time will tell you that, yeah, the current market is really a challenging market, because there's just so many different fundamental stories that are just bouncing against each other. Okay, there are so many stories that it's very difficult for traders to get a clear picture of what the market wants to do, and I think we're seeing that reflected on a lot of these daily time frames. I think we could even see in terms of what traders are expecting on some of the COMDOLs. You take a look at what's been happening on the dollar Canada. It's been trending higher very slowly, but not with a lot of conviction. A lot of this movement higher on the dollar Canada has been a somewhat stable dollar. I won't call it strong because it's really in a wide sideways range on the daily. But I think this loonie has been losing ground against the dollar, as we can see with the movement higher, the green grab candles, that kind of meandering but slightly upward angling 34 EMA wave. It's really reflective of crude oil dipping below $100 a barrel. So if you take a look at crude and what's happened since really we had that fairly sharp breakdown back on the 15th, you'll notice when we dipped down below 95, we really just started accelerating towards 90, which we actually hit yesterday. No, actually we hit 90 today. We hit 90 today. But once we dipped below 100, and we were kind of gravitating around 100 for most of May. We were kind of getting to about 105. We'd get back down to about 95. We were going around in about a $10 range, with the 100 level being the center and just kind of moving around it. Once we broke 100 and once we broke 95, you can see that we're starting to there's definitely a certain amount of weakness that's being reflected on crude oil. And then what's happening to the loonie? The loonie itself is definitely losing against the dollar, even though the dollar really, in the bigger picture, is not going anywhere. Now, I know a lot of people might say, well, Rocky, the dollar's up. Well, for those of you that are looking at the dollar on a daily chart, what you'll notice is that it is in a wide sideways range with a world of resistance, just a really thick layer of resistance waiting between 76 and 76.50. To the downside, we're getting support kicking in at about 73.50. Okay? Near term, we're getting support kicking in about 74.90 to 75. So we're really not moving anywhere. We're not making any kind of significant higher high through 76, 76.50, and really not making a whole lot of lower lows through 75. So we're stuck in a range, in a narrowing range at that. Okay? So again, I'm assessing this from the daily. So I think that's a big part of why it's been so challenging to assess what the market's been thinking, because there hasn't been really a clear dominant opinion. As far as, how often pairs are trading sideways or trending, I don't think there's any way to say that there's a percentage of time that a pair is moving sideways versus trending, because, quite frankly, I don't know of a tool that traders consistently use to say a market's in a trend or not a trend. Now, if you just take a look at this chart of the dollar Canada, for example, we're looking at about 10 months of price action, and I'd say fairly conservatively 80% of that's been moving consistently lower. Right now we're moving a little bit slightly higher, but arguably sideways. So, I try not to subscribe to pairs moving for example, 50% of the time in a trending manner or 50% of the time in a non-trending manner. I just don't think those percentages accurately apply, because there is no, I think, general, well-accepted way in which traders say, yes, a market's trending or not. So, in that respect, I have to respectfully disagree. In terms of price action from the last year, going back 12 months, I think 2011 has been challenging. I think 2010 was fairly straightforward, especially if you're trading COMDOLs. We had tremendous strength behind the up and down trends because the dollar index was just sinking to new lows, it seemed like every single day. Right now, I agree though, most of the pairs are moving sideways, for sure. Okay? Right now they are. But again, I try not to subscribe to some overarching idea of how often a pair is trending or not trending. However, for sure, right now, it's very difficult to find that daily directional bias that's clearly giving you some sort of clarity on the market psychology. So, I think it's really important to consider that before you do anything, because it gives you a decent idea of what the general consensus is of the pair. Okay? That's something definitely to think about. Now, if I were going to step back and ask myself about for example, let's move on to another pair. And if there is a pair that any of you have a question on, let me know. Let's step back and look at another pair. I think another one to look at, which has been, again, challenging, would be the Aussie. Look at the range on this thing. Is there any dominant market trend? I think one of the questions that a lot of traders have, because right now the markets, and I'm a technician, I'm a chartist, more accurately. And right now the markets really are very much fundamentally driven. So there are times where price action tends to dominate the psychology, and there are times when there's definitely not the clarity in price action because traders are just trying to digest the constant flow of new data. And I think right now it's definitely the case with what's happening in the market. There's just a constant barrage of what's going on in Europe or Greece, everything. So which news item is being digested at the time, it's sometimes very difficult to determine. I'm less interested in the fact that I've identified not only the correct news item that's affecting price action, but also the impact that it's having. Because there's so many ways that you can look at a piece of news and ask yourself what exactly it means. All right? So it's difficult to identify what's being digested as far as all the different pieces of news that are out there. And then on top of that, I think it's really challenging to try to figure out how much the impact we're seeing, in terms of the discounting of that piece of news. Think about what the market does. It's a discounting mechanism, right? The market's a discounting mechanism, which means it's always looking forward. All right. Now, when I see this kind of price action, I may not know what it is that traders are considering, and I think, Mark, your comment is perfect for this. I don't know. You ask about the impact of the Chinese on the euro. I honestly don't know. And really, I haven't considered it, not because it's not important, but because I can see that there's a lot of confusion in the euro-US dollar right now, just based upon that daily directional bias. The fact that we are arguably in distribution on the daily euro-US dollar. Distribution is a market phase that reflects confusion and a lack of organized sentiment and momentum. Therefore, we lack the trend. So, what we're lacking maybe on accurate info, what we're lacking on a consistent message out of China or out of Europe, we can actually see and measure what that impact is by using the chart. That's the chart. That's what the chart does for us. Price becomes a gauge by which I don't even necessarily have to understand what's coming out of those two countries. And a lot of times we know part of the game that these banks will play, these central banks, these governing bodies will play, is to send out a convoluted message. We know that's part of, heck, what did Ben Bernanke do yesterday? To keep the market from doing anything rash, to keep it in a range, to keep it from taking off in one direction or the other. If you send out a confusing message, one that you say, well, we'll act if we have to, but we don't want to. That's essentially what Ben Bernanke told us yesterday, right? What did he basically do? He was able to rally the dollar. I don't even know if that was his goal, but the dollar did rally because there was this one aspect of what he said which led traders to believe that we're done with QE, with quantitative easing. But then he left the door open, which will likely keep the cap on the dollar between 96 and 96.50. So by sending out these confusing messages, these governing bodies, these central banks can basically keep prices in place. I think that's one thing that Japan's trying to do. They haven't really been able to keep the strengthening of the yen to a minimum. I mean, here the yen is right back down at 80 again, right? But just with, I think, sending out a somewhat confusing message as to what they want to do, they're at least able to hold it within the current range just above 80. And you'll see that happening a lot. When you go, well, why isn't this governing body being clear? They don't want to be clear because they know a lack of clarity leads to confusion, and confusion will more or less keep price action in a wide range but somewhat in place. prices trend when everybody agrees. Okay, when they all agree to be bearish, when they all agree to be bullish, that's when prices trend. So if you think that the governing body wants to keep prices in check in a certain range, watch how they send out confusing messages, conflicting messages. That's part of the game. So, don't necessarily go, oh, they're not making any sense. Ask yourself why they're not making sense. And when they are being very clear, again, ask yourself, why are they being very clear? They're trying to elicit a reaction, right? Clarity elicits a reaction. A lack of clarity elicits confusion and range-bound pricing. And I think we can see that confusion across all the time frames right now, which brings me back to something I kind of wandered away from, the topic of our discussion, which, quite frankly, aggressive swing trading is not difficult. Okay? Once we realize that the directional bias, the daily, is lacking any kind of clarity, that can certainly drive us to shorter-term intraday time frames. So if I were to go back to that Aussie, where we had that really tight range, I certainly don't have a trend in the daily Aussie, right? What about the 15-minute chart? A little bit of an uptrend on the 15. So I have some clarity in terms of that 12 to 2 o'clock angle. Okay? I'd have that 12 to 2 o'clock 34 EMA wave angle indicating a mark-up trend. Now, this mark-up trend is coming as prices are doing what on the daily? They're coming off this area of support, right? So we're at the bottom of the range. Prices are trying to move up higher. We can see an early indication of that on the 15. By the way, those of you that really like that between the green setup that I've taught here in the class in the past, you can certainly use that as well. Okay? Between the greens. Perfectly viable alternative to take smaller trades more often and not being in a position where you need organization, momentum, and sentiment to give you any kind of a longer-term follow-through. Okay? All right, so that's what's happening on the Aussie, and if you do want to take advantage of coming off that floor on the daily time frame, the 5 or even the 15 might be a viable time frame for that. Wait for the pullback. Now, here's where we can talk about an aggressive swing trade. I've got a very narrow range. I've got a lack of any kind of opinion on the daily time frame of the Aussie. You'll notice that I have a number of moving averages on this chart. So I've got a trio of 34 period moving averages. Of course, that's the wave. I've got the 20 period simple, which is right up here next to price action. And I've got a 200 period, I believe, on this chart. Let me double check. We really don't need anything other than, I guess, a 50. Yeah, I don't even need the 50 on there. What I recommend, if you want to keep the charts fairly clean and simple, 34 EMA wave and a 20 period simple. If you want to add one more indicator, 34 EMA wave, 20 period simple, 200 period moving average, 200 period simple. If you want to add one more, 34 EMA wave, 20 period simple moving average, 200 period simple moving average, and a 50. A 50 period simple. So the 50 is usually my last additional moving average. I just assume focus on the 20, the 200, and the wave. Now, the 20 period simple moving average is one of my favorite ways to set up an aggro swing, an aggressive swing, because, I don't have to go about looking for a Fibonacci. I know not a lot of you are fans of Fibonacci. I know not a lot of you necessarily have the confidence in your Fibonacci drawing skills to use it on a regular basis. A lot of times, even if you do draw it, the lines and levels really aren't in play at that moment. The proximity isn't there. I know a lot of you love the kind of mechanization of having moving averages just tell you this is where the support and resistance are going to be. So because of that, I think the 20-period simple, and you can even throw in psychological levels, are great ways to have alternatives to corrections to the wave for that more conservative swing trade. Just remember, if you're looking at a shallower correction, which of course the 20-period simple in this case definitely is, it's an aggro entry. Okay? So what we're looking at right now in the 15-minute Aussie US dollar is the 20-period simple moving average acting as an aggro level at which we could enter. Now, let me mention some about aggro levels and your position sizing, because this is really important. The aggro level is a shallower correction, so we have to keep in mind the possibility of a deeper correction. Okay? We have to keep in mind that there's definitely a possibility that prices could move down lower. If they do move down lower, in the case of this uptrend, then what we want to do is still have enough buying power in our account to add to that position. Also, at an aggro level, I'm not going to add a full complement of my position sizing. So, for example, if I typically trade about 4 to 6 lots on average per entry, and I've allocated maybe 4 lots for this trade, when we hit that 20-period simple, I'm probably only going to enter with 1 lot, maybe 2, but probably only about 1 lot. Keeping in mind that the more conservative entry, at the 34 EMA high in this case, will be where I could put in the remainder of my position. So an aggro is not meant to be entered with your full complement of lots. It's meant to be a place where you can go ahead and stick your toe in the water without a major commitment in position size. Keeping in mind that if we move lower, you can put the remainder of your position on and not become top heavy in your entry by getting aggressive, overly aggressive, at already an aggressive entry point. Does that make sense to everybody? So the position sizing at that shallower correction, in this case that 20-period simple, should be smaller. To me, about 1/3 to 1/4 of your overall desired position size. Okay? If you start going half, that's fine, but just make sure you're comfortable with the risk that you're taking on, because remember, your point of validity for this swing trade is still just below the 34-period EMA low. So what you've essentially done with an aggro entry is you've reduced your reward, so to speak. You know, the distance to your profit target has been reduced, and the distance to your stop loss has been increased. Okay, which is not typically what we want to do, but we're acknowledging that in an environment where there is not a dominant directional bias, a dominant up or down trend, that sometimes aggro entries might be all we get. Okay, so while it's not ideal, hence being aggro, cutting from your reward, increasing your risk, we still deem it a valid entry, and then we control that increase in risk by a smaller position size. Okay? All right, so let's see. I got a couple questions that have popped up. Is there a possible, Art asks, is there a possible 1, 2, 3 on the hour chart of the Aussie or even the Euro US dollar? Well, we're a little off topic here with the conversation going to 1, 2, 3s. 1, 2, 3s, for those of you that aren't familiar with them, are Charles Dow reversals. On the 1-hour chart of the Aussie, I don't see one right now. On the 1-hour chart of the Euro US dollar, and I usually focus my 1, 2, 3s typically on a daily time frame. I don't see one, again, right now. what you really want to utilize when you find a 1, 2, 3, and I'm using the Charles Dow 1, 2, 3, is you want to find a dominant trend first, and then you want to go ahead and try to identify the reversal in that dominant trend. So usually I'll try to identify those on a daily chart by first seeing a 52-week high or low. If it's an intraday chart, you want to find, if it's like a longer term intraday chart, maybe it's a 1 month high or low. If it's a shorter term intraday chart, maybe it's a 1 week high or low. If it's a 5-minute chart, maybe it's the day's high or low. So consider that. I want to find a considerable high or low because that's going to be my number 1 point. And those are trend reversal entries. And oftentimes, by the way, those will also coincide wave reversals. Wave reversals, the ones that I will confirm with a CCI reading. That's often what I'll do there. Okay. All right. Let's see. Mingying asks, would I consider the cable 15-minute? Let's head on over to the cable. And since I'm on the subject of the cable, let's start off with a view of the directional bias of the cable. Okay, so the first thing we want to do, look at that daily chart, ask ourselves, is there a dominant directional bias? Now, I will tell you, this was a pair that I was actually looking at for a potential fade because we are in a distribution market trend, which makes it volatile. All fades are aggressive entries. Okay, so I was looking at potentially some support coming in around 6,100. Did not get it. Hot knife, butter, 6,100. And here we are down at 6,000 major psych level. Now, it is another level of support. I was thinking maybe we'd get support up in this area. Now we're at that second layer of support. Now, could we get support here? Well, here's the challenge. Is the 34 EMA wave coming around to show us that maybe we're in the very early stages of a transition to a 4 to 6? This is a transitional market. It's not as clearly a distribution trend as it was before we made the lower low today. You know, since we went down and tested 6,000. There is definitely a decent argument for a fresh markdown trend beginning. Got a good number of red grab candles behind us. 7-month uptrend line has been broken. 6,100 level has been broken. It looks like the bears are really gunning for the 200 period simple and 6,000. So there are a number of levels at which we could really see an acceleration of the negative sentiment in the cable. Now, we also got to consider that the dollar index could continue to slip from here. And this is where trading on these longer term time frames is not really a good idea right now, and that's why I definitely prefer the shorter term. So we'll make our way down to that 15-minute here in just a moment, Mingying. But I want people to realize that if the dollar index is topping out at around 76 to 76.50, and I'm trying to get follow through lower on the cable, those two price action, those two movements are at odds with one another. So I realize there's a lot of confusion on the daily. I can move down to, and again, one of the ways I was trying to capitalize on the confusion, by the way, for those of you that do read the daily forextradingedge.com site where we have a lot of updates and commentary, I was trying to take advantage of that confusion by identifying an oversold market. Did not work out. That's how aggro trades can sometimes be. So in terms of the 15-minute, the question is, would I consider the 15 12 to 2 and suitable for a swing? Well, so what's the look back on a 15-minute time frame? It's approximately 3 to 5 days. So I would not call it the best 12 to 2 I've ever seen. But it's probably more 12 to 2 than anything else. I've got we're dominated by green grab candles for the most part right now. in the near term. Excuse me one second, gang. All right, so I wouldn't call it the best 12 to 2 that I've ever seen, but there definitely is a certain amount of bullishness behind the move. So, you know, in terms of an aggressive swing trade, we would have already triggered one at the 20-period simple here. And here we are now at the more conservative level. Exactly the reason why we only want to enter with about 1/3 to 1/4 of our overall position. And then this way we could have entered the other 2/3 to 3/4 of the position down here at the 34 EMA high. I wouldn't call it a great swing buy, but one of the things I do like about it is the fact that we can use the 000 of 6,000. So what it lacks in a really great, clear 12 to 2 o'clock angle, we definitely, and what we, you know, one of the things to keep in mind is if we are starting to transition into a markdown on the daily, this is, in essence, a shorter term time frame, but it is potentially counter trend. I've got to keep that in mind as well. But 6,000 could be reason enough to take this kind of aggro swing buy. And I do believe it's aggro, not because we're taking a shallower entry. It's aggro for a different reason. It's aggro because we might be fighting the daily directional bias of this pair, which could freshly be down. Okay? But 6,000 is probably the line in the sand at which the bullish and bearish momentum are colliding. If we break 6,000 with some dollar strength, we could see some decent follow-through. Now realize we have broken it already. We went all the way down to 59.38 today. So we stabbed 6,000, got below it in a fairly significant way, but still we're able to see the bulls were able to get the prices back above the 000. Not by much, but they did it. So near-term momentum is bullish and on the side of the 15, but the longer-term directional bias may not be. So in terms of this particular entry, it's probably viable because of the 6,000. All right, let's talk about another question here. You know, it's kind of, I have to mention again, it's sometimes difficult to go back in time when you guys ask me questions about trades that have already happened a few days back, but I'll do my best to do it. It can sometimes be a little challenging to, you know, find that particular moment in time, but I'll do my best here. So the question's about the 1 hour Euro Yen. And it's regarding a swing entry. Going back to the 21st. Okay, so I can see what the idea was here because we were in that 12 to 2 o'clock. Okay, now the daily Euro Yen is doing what? It's chopping around with, for now, kind of a dominance of bearishness, but I would still call this a distribution market trend. However, we're not likely to get support in this distribution market trend until we get down to this area. Okay, just as we're likely to get resistance when we get up to this area. So we're in the middle of a distribution market trend. Anytime we lack directional bias, what do we want to do? Short-term time frames, right? 5, 15, 30. We talk about this a lot at the Daily Forex Trading Edge. 60 is right on the fence, though. 60 is very difficult to, it's kind of a difficult one to say is a go-to time frame when we lack directional bias. 5, 15, 30, easier. 60, kind of on the fence. 240 is a no-go. When it comes to, again, a lack of clarity, sometimes it's very difficult to get the follow-through that you want to get. All right. So with that in mind, I agree with the 1 hour assessment of the swing right off the bat, okay, at that moment in time. Okay, it had worked a number of times along the way higher throughout the 20th and 21st until we got up to about, this 150, what are these highs here? 115.61, 115.59, okay? Corrected, and we saw what happened. You know, we transitioned and started moving down lower, sharply lower. Number one, you got to know what moves that euro yen. Look at the Dow, look at obviously euro as well. Anytime you've got the euro worked into one of the pairs you're trading, you know you're in for a bumpy ride, especially with the news coming constantly out of the ECB in Greece about how they're tackling those problems. Really a pair that I've been avoiding right now, two pairs have been the euro US dollar and the euro yen. Just two nightmares right now with just the constant barrage of good news, bad news, good news, bad news. It's really quite maddening right now. So a lack of direction on the daily chart. Now, as far as we go to the higher time frame, we go to the daily. I never recommend multiple time frame confirmation. Never, 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 never. I don't say never often. The higher time frame that you're looking at is the daily. So if you're looking at 60, I'm never going to tell you to look at a 240. If you're looking at a 15, I'm not going to tell you to go to a 30. You look at each of the individual time frames as standalones, but you can look at the daily for that directional bias. Okay? So when you go to the higher time frame, don't just go up to the next higher time frame intraday. It's the daily. Okay? I never talk about multiple time frame confirmation. That I know for certain because I simply just don't do it. Okay? Now, as far as the directional bias being in distribution, I'm 100% with you there, Minion. You're absolutely right. The 1 hour, if you had to choose between the 1 and the 4, as you did there, the 1 hour would have been better than the 4 hour because of distribution. You know, but usually I'd even go shorter with the 5, 15, or 30 and look for a setup there. 1 hour, like I said, is right there on the fence. So as far as the swing, it wasn't a bad swing that you were looking at. And in fact, it had worked throughout the day. That would have been probably the third or fourth time that the swing had set up, right? Before it failed. It triggered 1, 2, 3, 4, 5, 6. It triggered a number of times. So obviously at some point the trend is gonna flatten out or even reverse. And at some point, even a swing trade, you're going to end up with one loser. So if your third or fourth entry at this point was a loser, at least you knew you were riding it up higher in the meanwhile. And that's often what happens, sadly, to a lot of traders is by the time they take a look at a trend that has begun, they've missed some of the early or even mid-trend entries, and they end up, sadly, taking entries that finally fail or don't follow through enough, and then the market reverses. So I think it's really important that, obviously, you identify the market trend as quickly as possible, and then you can start putting to work that swing trading plan, whether it be an aggro off the 20 periods with a smaller position size or the more conservative 34 EMA high in the case of this uptrend with a larger position size. Okay? All right. Directional bias is always taken from the daily, gang. Again, the daily being the most psychologically significant time frame. So we always take the directional bias from the daily. I do not use multiple time frame confirmation, so I won't use a 4 hour or a 1 hour, anything else. Always the daily. Okay? In terms of making a decision, when you have multiple time frames doing multiple things, this is classic triage. Triage dictates you do a couple things when you're choosing from what could be multiple trades across multiple time frames. First of all, absolutely, you want to recognize the daily directional bias. Okay? Then you want to go about your clarity determination. In other words, which time frame has the clearest market trend? So if you're trying to make a decision between the 1 hour or the 15-minute, you start making your way down clarity. So which one has the clearest clock angle? That's the first thing. Now, the 1 hour versus 15, I think that decision is probably a little bit easier when there is a dominant directional bias. And again, all trading becomes much more difficult when we don't have a dominant directional bias in the daily. It becomes much more difficult. I think 6,000 gives the 15-minute time frame, and that slightly better looking 15-minute 34 EMA wave angle, I think that gives it the slight advantage. I also like that it's a short-term time frame. Okay? But what does the 1 hour have going for it? Well, here's what the 1 hour has going for it, and there's no right answer or wrong answer here. It's a difficult decision. If we are in the very early stages of a market transition, which is a viable argument for the cable, the 60-minute is a trend following while the 15 is counter. Is it better to counter or follow the trend? For my money, in my opinion, I'd rather follow the trend. But the daily is far, far from creating a very clear bearish trend. It just has a lot of bearish sentiment and momentum behind it right now. So I would give the slight edge to the 15 right now. Okay? The two main reasons is it gets to use 6,000 and it's a shorter term time frame. I'm not as married to longer term organization of momentum and sentiment. So that 20 period simple, that 34 EMA high are I think valid ways to look at taking advantage of maybe a little bit more of a bounce. Not to mention, if we are going to continue to see the dollar index lose footing after testing 76 today. So are we going to start heading down towards 75? Now, that's another very realistic consideration for the dollar index, since it is also in a sideways distribution, sideways wide volatile market trend. Okay? All right, gang, so that is our hour for today. Thank you so much for joining me. Great discussion, by the way. Thank you to Mark and Ed and Joseph. Thank you to Cynthia and Mingying, to Richard, to Kareem, and let's see. There's a question here about the CCI for a reversal. Again, I try to, gang, I try to stay on the topic of our discussion, but as far as, I did mention it, so as far as a CCI reversal goes, you use a negative 100 CCI to confirm a breakdown of the wave, and you use a positive 100 or greater CCI reading to identify a breakout. So what I would tell you to do is at the YouTube channel that we have, if you head on over to www.youtube.com/Interbank FX videos. It's videos plural. You'll see a number of videos there, and what you're probably looking for is one about a wave reversal, or what I call a wave CCI. You can even Google that. I've got a number of articles out there on that. And maybe we'll do a future discussion of that here in the chat room. So thank you very much to everybody. I appreciate your time and your questions. Very thoughtful questions. Good stuff, gang. It really made it feel like a really robust discussion today. So I appreciate that. I will see you all next week. Okay? And as always, thank you for your time. And I will hopefully, I will see you all considering that directional bias before you enter your trades. I think it's really going to help you with the market psychology analysis that you should really be considering before you put on any trade. Take care, everybody.